What's going on, everyone? Let's get back into this video. And what is the 7 ETF I recommend to buy? And remember, this is not financial advice. These are 7 ETF that I own in my retirement account or across a few accounts. And I recommend to buy and hold forever. Now, I'll give you the good, the bad with each one, but I recommend these so that you could retire early. Now, why do I recommend ETFs?
Here's how an ETF or exchange traded funds work. An ETF is a collection of things like bonds, stocks, and other assets like commodities. A common form of ETFs are index-based ETFs that seek to track the performance of the underlying index, some which follow the overall stock market.
Well, in this video, I'll tell you why.
ETFs or stocks? Which one's right for you? Let's break it down. Stocks? You own a piece of one company. That means all your risk and reward depend on that single company. Great when they're up, not so fun when they're down. ETFs, on the other hand, are like a basket of stocks. You own a little piece of many companies, giving you instant diversification. Less risk? Yep, but potentially slower growth compared to individual stocks.
Now, why do I recommend it? Is because it's easy, it's basic, and you do not have to put a lot of effort into it. Now, each one of these ETFs have something different about them, but they're all good ETF to have. And I do recommend buying some of these to add to your portfolio for the long term. And why do I recommend ETFs? It's because it's simple and you don't have to go a lot into them. Now, each one of these ETFs have some good and bad about them, and you can build each one of these into a multi-million-dollar portfolio just by investing them automatically and forgetting about it, and they will grow and work for you. And that's the main goal, is to build a portfolio that will work for you and you do not have to put a lot of effort into it. So, and what's the first ETF I recommend? It is VOO. And here's the rough summary of VOO. So VOO has a $590 billion AUM with the expense ratio of 0.03%, which is pretty low for a expense ratio, with a 10-year average of 12.46%. And the best year, it had about a 28.79% in 2021, and the worst year it had a negative 18.17 in 2022. So let's get into this. This does pay a dividend of 1.12%, and per share you get about $7. Now, why do I recommend it? It's because it's shown to have a proven track record. So if it has a good track record, it is recommended to buy it. Now, let's say you invest $20,000 in this, and what do you expect to have in 5 years? If you invest $20,000 right now, you expect to have $40,000 in 5 years. And this is the number right here. So it's not hidden, it's proven strategy. And the other thing is they have the top holding is NVIDIA, Apple, and Microsoft. So it has 3 really good tech stocks. It also have Amazon, Broad Inc., Alphabet, Meta, and Tesla. So it's very heavy in tech stock, but it's a very good one to have. So that being said, what other stock do I recommend? Well, remember, you're holding this for a lifetime of the portfolio. You're not trying to sell it. And the next one is going to be VGT, Vanguard Informational Technology Incorporated. And again, what are some of the things about it? So it's a 75 billion AUM. If you don't know what AUM is, it's how much money the fund manage. And it has a 0.09% expense ratio with the average return of 18.93%. And the best year, it did a whopping 52.66% in 2023. And the worst year, it had a negative 29.69%. And that's crazy return in 1 year. It pretty much doubled. But let's look at this. It has a dividend per share of $3 and it pays a dividend yield of 0.41% for those people who want to invest in a dividend stock. Now, the top holdings it has, again, NVIDIA, Apple, Microsoft, AVTO. It has PLTR, Oracle, AMD, Cisco, and ABM. So it's very heavy in technology. Of course, it's a Vanguard Information Technology Index. They're going to be heavy in it. Now, I'll give you another example of investing $20,000 now. What will your 5-year return be? It'll be a whopping $46,059. It'll be a whopping $46,590. So it gives a good return, and I recommend adding these to your portfolio. Yes, you can mix it up. So, number 3, I recommend to have for long term is QQQ. And what reason why I recommend QQQ, they have asset under management, AUM, of $302 billion with a expense ratio of 0.20%, with a per year return for the last 10 years of 16.99%. So it has great returns, and I can't talk without telling you the best year and worst year. The best year, it did a whopping 54.86%, and the worst year, it did 32.58%. And yes, it's another dividend paying stock. It has a dividend yield of 0.46% and a dividend per share of $2.86. Now, you see that the performance has been doing outstanding. And now, let's do $20,000 again. What will happen if you invest in this for 5 years, $20,000? It'll give you a whopping $42,360. $42,360 in total asset. So it doubles in 5 years. And their holding is NVIDIA, Apple, Microsoft, Broadcom, Amazon, Tesla, Alphabet again, and Meta. So you notice a lot of these companies invest in the same thing. So it's a great company to have. All right. My 4th stock I recommend is Vanguard Total Stock Market Index Fund, VTI. Now, let's go into how much do they have under asset under management. VTI has $442 billion under asset under management. They have a expense fee, annual fee of 0.03% with 11.74% per year return for last 10 years. And the best year, it did 30.67, with the worst at being negative 19.52. And yes, it pays a dividend at a 1.11%, a quarterly payout with a 3.75%. And put another 20,000 in, and let's see how much money you'll have. And it'll give you $38,340. And they have, again, NVIDIA, Apple, Microsoft, Amazon, AVTO, Google, Meta, Alphabet, and Tesla. So you notice that most of them have almost the same thing in their portfolio. So this is almost all heavy in tech. So make sure if you're going to diversify, you pay attention what's inside of the holding, because just because you pick an ETF does not mean you diversify. Make sure you see what's inside of them so you can diversify your portfolio. Now, the next one I'm going to talk about is VXUS. It's Vanguard Total International Stock Index. And the reason why I picked this one is because you need to diversify with United States stocks and international stocks. Now, how much do they have under asset under management? So VXUS have 82 billion asset under management. The expense ratio or expense fee is 0.05% with a average return last 10 years 5.24%, and with the best year of 27.46 and the worst year of 16.08. Yes, it's not as good, but you need to diversify with international stocks, and they pay a dividend yield of 2.72% with a dividend per share is $2.04. So, what happens if you put $20,000 in this stock? What will happen in the next 5 years? You have $29,630. Now, let's look at the holdings so you understand. So they have Taiwanese Semiconductor, Vanguard Market Liquidation, Tencent Holding, ASM Holding, Alibaba Holding, Samsung, SAP. So they have a good diversification of good companies in their portfolio. So let's move on to our next one. It's VT, Vanguard Total World Stock Index, another international stock. And we have to see how much asset under management they have. So VT has $41 billion of asset under management. Their expense ratio is 0.06% with a 10-year average of 8.91, and the best year is 26.82% with the worst year of negative 18%. So this is a good stock if you do not like the other international stock because it doesn't give you a good return or you don't think it gives you good enough return. But it's another dividend paying stock at 1.66% at a $2.34 year return. Now we're going to do it again. $20,000 5 years. You'll have $34,410. And yes, this is how much you get in 5 years. Now, what do they have in their portfolio? Nvidia, Apple, Microsoft, Amazon, AVGO or Broadcom, the Alphabet, Meta, and Tesla. So they have some good stocks in there, but you notice that almost all these portfolios have the same stock in them. And lastly, it's SCHD. Now, SCHD has $70 billion on asset under management with the expense ratio of 0.06%, with a 10-year average of 11.43%, and the best year of 35.61%, with the worst being negative 5.58%. So it pays a dividend yield of 3.75 with a dividend per share of $1.03. So it's a pretty good stock to have. I have majority of these stocks in my dividend portfolio, and we're gonna put, or not my dividend, my retirement account for my Roth, so I could diversify and not worry about them. But it has an estimated return of $20,000 in 5 years. It will give you $30,000.95. And this one has different stocks in it. It has Cisco, AMGN, AbbVie, MRK, Lockheed Martin, Coca-Cola, CVX, or Chevron, Pepsi, and BMY. So those are the stocks I recommend to buy and hold for a long lifetime. After going over those 7 stocks, you don't have to buy all of them. But I do recommend you buying these stocks to add to your portfolio for longevity because they're great stocks to have and they have a proven track record of 10 years of having good returns. And they have a cheap expense ratio. So all these stocks, if you invest in them, you will do fine. And this isn't for the advanced. So I'm sorry, we're just doing the basic for someone who wants to know what ETF to add to their portfolio. So, like and subscribe to my video, and some of these stocks made me a millionaire. So, like and subscribe.